Hi, I'm William Thayer. I'm talking about the euro crisis. I'm talking about how to save the euro. Now, unfortunately, it's not going to be how to save the pigs, as this picture shows. This is the fourth of 5 videos on the euro crisis. Let me review the Eurozone depression scenario that I laid out in video 1. First of all, the Eurozone is going to run out of Euro-TARP money. Secondly, the pigs will default because they're totally dependent upon bailouts. That's going to be a $1 trillion loss. Third, the stock markets are going to crash because they were reassured that everything was okay, and in fact it isn't. That'll be probably a $2 trillion loss. Fourth, interest rates will spike. That will cause losses in interest rate swap derivatives. That's worth another $1 trillion. And $4 trillion of losses, well, for the Eurozone, that means depression. So how do we save the euro? Well, first of all, instead of letting the 3 little pigs default simultaneously, you plan the defaults, and I'll get into that a little bit later. Secondly, you close the stock markets prior to each default and take preemptive steps, and I will discuss what those preemptive steps are later. Okay, that should cut the stock market losses down quite a bit. And third, you suspend derivative settlements. That will save the Eurozone at least $1 trillion. This is $1.5 trillion of losses in my little scenario of how to save the euro. That's a pretty bitter pill to swallow for Europe. But unfortunately, that's reality. You got yourself in this mess, you're going to have to take your medicine. You're going to take some losses. It's going to be a nasty recession, but it won't be a depression. Now, what are these preemptive measures that I'm talking about? I'm talking about, first of all, spacing out. The pig defaults are inevitable. So you've got to space them out. So first you have Greece, then 3 months later, maybe it's Portugal, and then 3 months after that, it's Ireland, okay? You close the stock markets, you announce, hey, the bailouts for Greece have stopped on Saturday. You close the stock market for the next week so that people can adjust, the European leaders can reassure everybody that we've got everything planned out, none of the banks are going to fail and stuff like that. And then you repeat the process later for the other pigs. You suspend high-frequency trading for a year. What's high-frequency trading? It's these computerized programs that trade at 1 million times a second. And why is it important? Well, the May flash crash of 2010 in the United States ought to be a message that everybody is paying attention to. Basically, what happened in 15 minutes is the Dow Jones average dropped 1,000 points. That was $1 trillion worth of stock market value in 15 minutes. Why? High-frequency trading is 2/3 of the market volume. When a big trade triggered the little computer programs that do this high-frequency trading, they just pulled right out of the market. When they pulled out of the market, there's nothing there to support prices, and prices fell like a stone. So if Europe wants to repeat the May flash crash on a gigantic basis, just let high-frequency trading continue, and you'll see something that'll be awesome, but it won't be good. The second thing you got to do is you've got to control the downward momentum. Well, what you don't need is you don't need short selling. Now, the French and the Italians have already suspended short selling for their banks. I absolutely concur. The SEC stopped short selling in our financial crisis of 2008. And the Europeans have got to, they're going to go through a year-long crisis. They've got to suspend short selling for a year. Short sellers say, well, we bring price discovery. Let me tell you, when things are going down, you don't need anybody to discover that. What they really do is they add to the downward momentum. Finally, you've got to suspend derivatives settlements for a year. Good and bad derivatives, I don't care. Most of them are bad, okay? And why you've got to do that is you're going to be looking at $1 trillion of loss, at least, if you don't suspend those, okay? Now, I think that 90% of the derivatives are bad. I think that they're actually not valid business contracts, but I'm not a lawyer, so take a year, figure it out. It's absolutely, positively essential that the Eurozone saves the Eurozone banking system. I'm not talking about the shareholders of the bank. They're going to lose, okay? But the Eurozone has got to print enough money to cover the banks. If they don't do this, it's going to be a repeat of 1931 and all the bank failures throughout Europe. It was agony in that depression time period. Hopefully we have learned from that. You've got to preserve the banks. Okay, so what's the end zone that I'm saying for saving the Eurozone, okay? Well, it's going to be a smaller Eurozone. First of all, the pigs aren't going to be there. Portugal, Ireland, Greece, they're not going to be there. Probably a few other little countries are going to go, like Cyprus, maybe Malta. Perhaps Italy and Spain may have to leave the Eurozone in 2013. I don't think they'll have to leave in 2012. But nevertheless, it's going to be a smaller Eurozone. The euro, well, when you have $1.5 trillion in losses you're taking, guess what? The value of the euro compared to the dollar is going down. Today, in January of 2012, it's $1.3 to the euro. I think it'll be $1 to the euro. Could even be less than that. And the end state for the Eurozone is it'll be a nasty recession, but it won't be a depression. It will be recoverable from. For the pigs, it's unfortunately, and I'm sorry to say this, it's going to be a depression. It's going to be like Iceland. What's Iceland's going through right now? Their currency, they're going to go back to their currencies. The Greeks are going to go back to drachma, and their drachma will be worth half what a euro is. This is just exactly what happened to Iceland. I wish I could say, you know, it was going to be better for the pigs, but it's not. Now, is there any hope for the Eurozone overall? Okay, or is this just going to plunge them into mediocrity forever? Well, yes, there is hope. And that's the subject of my last video, which I call the Max Weber solution. Thank you very much for your attention.